Good afternoon, everyone. Welcome to the RSI quarterly webinar for Q4 of 2025. I am Carrie Wall. I'm part of the RSI staff support for today's webinar. We'll go ahead and get started shortly. We're just going to wait another minute and a half or so for some other individuals to potentially pop in. All right. Again, welcome everyone to RSI's quarterly ARCI webinar covering Q4 of 2025. I am Carrie Wall, RSI Senior Director of Regulatory and Industry Affairs. And I would like to introduce our two speakers for the day. Eric Starks and Joseph Towers work at FTR, the industry leader in freight transportation forecasting. Eric is chairman of the board and is one of the premier industry forecasters on transportation equipment demand for rail cars, commercial trucks, and trailers. Joseph Towers is the senior analyst of rail, and his experience lies in market analysis, data science, and economics forecasting. So thank you so much to both of you for joining today, and I'll hand it over to Joseph to kick us off.
Excellent. Thank you, Carrie. Thank you to RSI for having us, and thank you to everybody online who's going to be joining us today. So we are going to start things off. If you've been on this webinar before, you kind of know a little bit about the flow and how that works. But what we're going to start off with is giving overall update on just the economy as it stands now and what our baseline expectations are for what the next 1 to 2 years is going to look like. Then from there, we're going to break out the freight environment. Eric is going to talk through the truck side, and then I'll take over, talk through intermodal and the carload space. And then we'll finish off the rest of the prepared content with breaking out what's going on in the rail equipment markets, both how the market's operating and then the latest ARCI results. We're going to break out some of the very interesting trends that we saw this past quarter. And then we'll have an open Q&A at the end. So any question that you have at any point throughout this presentation, please put them in the chat and we'll do our best to answer all the ones that come through once we're through with the content. So starting off is going to be overall economic conditions. And with that, I'm going to turn things over to Eric. Eric, over to you.
Oh, Joseph, thank you. Carrie, thank you. It is so wonderful to be here with all of you. And we very much appreciate and value the relationship here with RSI. So it's a joy to always do these. So hey, let's just get right into it, right? The economy, we all know what's happening within the economy, right? It's easy, right? We're just autopilot. So if only that was really the case. So there is a lot to talk about. I'm going to key in on a couple things because I really want to just kind of highlight a baseline. What is our base forecast so you can say, okay, this is what's driving that. But let's start initially with talking on payroll, right? So payroll employment numbers basically tell the story of what's been happening. We have seen the payroll employment numbers tailing off and basically on average been staying around zero. And so what that tells us is that the economy has kind of stalled out. So it's not necessarily in a recessionary environment, but also the ability to see growth is going to be somewhat difficult. Now, there are a couple things that are happening within this space, and we need to talk about this. One is the government shutdown kind of threw a lot of things off for data collection. We're going to be about not quite a week behind when they give us the January numbers, so that'll come out next week. They delayed that a little bit due to the short government shutdown that we saw this past weekend. The ADP numbers came out. They were fairly anemic. They were in positive territory, so they were above zero. But overall, they were weak. So right now, this is going to be one of the problems that we're trying to understand because this percolates through everything. And the interesting part about this is it's not just like all industries seeing some slowdown. There are some industries that are seeing substantial growth, and there are other industries that are seeing a drop. And one of the things that's a big thing for all of us is manufacturing. Manufacturing, those numbers were down pretty significantly for ADP. That just came out. And so ultimately, that has been somewhat of a problem. So this is something we're going to have to pay really close attention to. This is what the Fed is paying attention to when they start to set interest rates, because they're saying what's happening within the labor market. And as of now, we're not seeing any turn. And I know that there's a lot of economists that are getting very concerned about what's happening there. Now, having said that, let's talk what's happening in the on the international side. What's going on with imports and exports? Well, we have seen at the top line there is imports. So this is in dollars. And it has been coming down. We saw that big jump once everything was announced for the tariffs. But since then, it has been kind of on a slow downward trickle. What's interesting, though, is the bottom, which is the export market, has been on a slow upward trickle. So part of the thing here is this is a bit surprising because what we had expected was we expected that the dollar would continue to appreciate and then it would start to increase imports and then pull back on the exports. That actually hasn't happened. We've seen the dollar falling, and ultimately that is good for exports, but it's not necessarily good for the dollar and for the global markets. And so we don't have time to get into all of that, but that is one of the things that we're going to have to keep paying attention to if the dollar continues to keep falling noticeably, because then it does not become kind of the currency of choice, essentially. And that's something that I think is a broader issue that we could take days to talk about, but let's keep moving on off of there. So when we look at some of those things we just kind of talked about, GDP is the broadest measure of economic growth that we look at. And what's interesting here is since we last spoke with you, we actually have raised our GDP forecast. And in fact, it's now sitting in an environment where we're looking at around 2% GDP growth. And if you remember, as we came out of the Great Recession, 2% ended up being a really good market because it was predictable. This is not that type of a market. This is a still unpredictable market in the sense of we don't have good certainty on what this looks like. So while our forecast came up and we don't see that near-term weakness that we were saying before, it's still not saying, hey, things are good. It is just saying that this is a baseline scenario for us to talk about, because there's a lot of things that are really almost impossible to model, right? When you look at the stuff that's happening domestically, Minnesota, you have obviously all the immigration stuff. You have Venezuela. You've got stuff still happening with Ukraine and Russia. We've Iran, Greenland. You just name it, and there are all of these things that create a more uncertain environment and are very, very difficult to put into an economic forecast. So what that does is that creates more volatility in what the outcomes could be. So this is what we're going to base our forecast off of, is this GDP number. Let's keep moving on just a little bit more, though, because when we break down GDP, what we're most interested in is what's happening on the goods side. And when we look at the goods transportation of GDP, is we saw that big jump and decline in the first 2 quarters of the year, and then we basically saw zero, and now we see limited growth as we go out. This is more indicative of what's happening within the freight space. There has not been a tremendous amount of growth within this space, and usually what we need to see for the freight markets to grow is we need to see this number above 2% and probably closer to 3%, and then moving up towards 5% before we start to see any noticeable growth within the freight market. And so right now, only to the end of 2026 do we start to see that occurring. Now, let's break this down just a little bit further. Let's kind of take the next step. So we looked at the goods transport sector, but what we also have to look at is the industrial sector. So if we look at industrial production, this is one of the areas that we have actually seen more solidification than we have at any point in time during the last year. We actually have seen that this market has started to stabilize. We had an assumption the last time that all of us were here together is that the industrial numbers were going to go into negative territory for 2 to 3 quarters. As you can see in the forecast right now, that does not occur. We do not go into negative territory. That is a good sign, but it's also saying that we never get to 2% growth or above. So we basically are seeing a weak industrial sector for the next 3 quarters. So that kind of holds us steady, but it doesn't create a tremendous amount of growth within this particular market. So ultimately, this is going to be what drives the freight market noticeably. So when we start to think about demand for rail equipment specifically, we really need to see this market picking back up to solidify that amount of freight that's in the system. Okay, let's keep moving on then. Let's talk about what's happening within the trucking space. And so I'm just gonna hit briefly trucking just to kind of give you some flavor of what's happening there. Then I'll hand this off to Joseph to keep going. So let's look at what's happening within the truck space. So within the trucking environment, the most important thing is freight. And I think a lot of people forget that. I think a lot of people look at capacity, they look at rates, they look at all these things, but freight is the driving factor. And so what we're looking at here is we're looking at the number of loads originated by truck. And that line is the number of loads on a seasonally adjusted basis. And then we also are looking at the year-over-year growth, which is the bars. Well, we actually have been in an environment where we have started to see year-over-year growth as of recently. And in fact, as we move into January into February, we're going to see decent year-over-year growth. We do expect that will start to subside a little bit, and we basically have a flat freight market when we look at the absolute levels of freight in the system until we get towards the middle of this year, and then we start to see some increase. Even then, we're only getting to about 2% growth. So the line looks like there's this huge growth in the system, but that's a scaling issue more than anything. So 2% is just okay. But this does have some impacts, broadly speaking, when we talk about the truck market. And the big one there is on capacity. So traditionally, we need to see freight growing at or above 2% to have capacity start to tighten. Well, that actually is not what's occurring this time. We've actually started to see capacity tightening already, and that continues to tighten through the middle of this year. And that's different than what I was kind of highlighting to you, right? We were saying freight was going to be flat, but this still says that capacity continues to tighten. A lot of this is being driven by one, additional pieces of equipment coming into the market isn't happening. We're just seeing replacement of that particular market, but also it's being constrained by drivers. We're seeing more and more drivers exiting the market, whether they're getting laid off or they have just decided to leave the market because the rates really aren't there. So this is kind of artificially driving this higher. So it gets us up into that 97 plus percent range. I think that's probably a little too high. It probably doesn't go quite up to that particular range, but that gives us a little bit more pressure on the rate side. So that then becomes where intermodal becomes more competitive to truck. And so we start to see some of that tightening. But this doesn't fundamentally say that you don't have enough equipment. It's just saying that there's some artificial tightening that's happening. So with that, let me pass this off to Joseph to talk through intermodal and then into the rail space.
Great. Thank you, Eric. So, like Eric said, now we're going to hop on over and just see how the other modes are doing, starting with intermodal first, and then go into carload. We always like to, on this webinar, kind of break out what has weekly traffic been looking like so far this year. And so we're going to go over that. It's January. There's only a few weeks of data, so there's not going to be a super clear picture just looking at those graphs. But it'll give us a good opportunity to just kind of talk through how has the year started off and what are some of the factors that are really shaping intermodal right now. So overall, it's been just an okay start to the year. Those first 3 weeks, we were kind of right in line with the 2024, with the 2025 average. And a lot of that is just because we're still dealing with some really strange year over year comparisons. This time back in 2025, um, we still had a lot of pull forward activity of a bunch of people that, while Trump at this point was kind of just getting back into office, there was already anticipation of very significant tariffs that were coming online, and so there's a lot of pull forward information early 2025. And so that has taken away from some of the year over year comparisons that we might otherwise see, considering that for the first 3 weeks of the year, we've actually been exceeding the 5 year average. So if it wasn't for those early 2025 comps, it would actually still be a pretty solid intermodal market. It's really just the strange things that was happening last year that's distorted that. And then we had that really big drop in the most recent week. You see that big green bar headed down. That's all weather related. So that was something that you'll notice on the carload side as well as the intermodal side. A lot of winter weather that came through the south and southeast, especially, that shut down a whole lot of operations. And so that's just one thing that brought down. But overall, it's been a decent start to the year with overall intermodal. But beyond just what's happened so far in 2026, I want to take a step back, talk through what did 2025 look like, and then what are our big picture expectations for 2026 and beyond. So looking at 2025 specifically, you'll notice a lot more stronger positive figures at the beginning of the year, which kind of covers a lot of what I was just mentioning, which is a lot of pull forward information, a lot of pull forward of inventories on the international container equipment side to get as much inventory forward before tariffs went into effect, just to stock up on some inventories, have some, if not to mitigate the effects of the tariffs, just to have a little bit of certainty, just a little bit of wiggle room on what to actually do, which was a good idea because it's still very recent history. We had a very volatile, still have a volatile, but even more so back then, just ups and down. Every single day, a different tariff rate was in place. Then, as we progressed through the middle of 2025 and then towards the end of 25, we saw that those intermodal numbers really began to moderate and actually went negative for the last 3 months of the year. You can't really tell, but December was slightly negative, down 0.1%. And then it's our expectation, and it's been our expectation, that those declines are going to continue into the first quarter of 2026. Part of that is a result of the tariff environment and just price elasticities, but then also is just how difficult year-over-year comparisons are going to be for Q1. But once we get past Q1, once we get into the second quarter and beyond, we do expect to see some improvement in overall conditions, but it's not going to be a significant market. I don't know anybody that is anticipating it's going to be a super strong market for overall intermodal volumes. And right now it's our expectation of just 1.3% growth in 2026, and then a pretty similar 1.3% in 2026, 1.6% in 2027. And one big sort of differentiator is that where in 2024 and 2025, it was primarily the international equipment that in international imports that drove a lot of the intermodal strength. We're seeing that the international side is going to be a bit more flat in 2026, and most of the strength that you're going to see is going to come from more of the domestic intermodal side. Part of that will be from places like new opportunities, like cross-border with Mexico has had a great year in 2025. We're expecting to see some of that continue. And then like Eric was saying, with the kind of tightening capacity in the trucking side, that's also going to be a benefit to the domestic intermodal side. So overall, it's going to be more the domestic as opposed to the international equipment driving 2025 volumes, which is the opposite of what we saw for the past 2 years. Next, we're going to talk through the carload side, and then after that, we're going to get into some equipment. So again, some pretty limited insights into what you can actually get so far, but across most of the commodities, at least through the first 3 weeks, remember that fourth week is really impacted by weather. It's been a really strong start on the carload side, very different from what we saw with intermodal. And it hasn't just been one single commodity that's driving it. Really, across the board, when you look at each of the AAR commodity groupings that they report out on a weekly basis, so far into the year, really everything is up with the exception of forest products. Forest products is the one area where we had a week 2024, we had a week 2025, and we now are having a week 2026 in lumber with the so-so economy and then tariffs on Canadian softwoods, both having a pretty significant impact on overall transportation of lumber products. But otherwise, agriculture is leading the way, especially in grains. But agriculture in general is doing good. Your non-metallic minerals, even metals, so far have been doing good, though we're not expecting metals to have a great year. But really, it's been a strong start on the carload side. Then we have our economically sensitive freight. This is just another thing that we always like to contrast this with. This strips out petroleum products, coal products, and grain to get a better sense of movement of goods that are more dependent on overall economic conditions. And similar picture. It's been a strong start to the year. Again, most underlying commodities have been showing growth so far into 2026, though admittedly we only have 4 weeks of information to actually go off of for now. Um, but I mean, there's been a whole lot of strength so far in the year, but we're expecting that that's going to overall balance itself out. A lot of that is just still with a pretty flat overall industrial economy, and then all sorts of uncertainty, and then tariffs still impacting certain commodities. So in 2025, it was a whole lot of volatility between individual goods. Some did great, some did really poorly. And overall, they really netted each other out quite nicely to where 2025 finished the year up just 0.2%. And then as we get into this year and over into 2027, again, we're not expecting to see any big fundamental shifts in how the economy operates. We're not expecting to see any robust growth in the industrial economy. It's really going to be a pretty flat environment like we saw with 2025, though some of the underlying drivers are going to be a bit different. And then same as we get into 2027. And until we see a real catalyst for growth, either in the form of a single commodity boom or in the form of just a broad bringing to life of the industrial sector that we really haven't had since COVID, um, we don't expect to see any big, robust levels of growth. Then it gets to be a little bit of a stronger picture as you take out some of those other commodities that we talked through. So 0.9% growth in 26, and then kind of more towards normal levels in 2027, with part of that being that it's our expectation that secular declines in coal specifically are going to continue as we get into the future. And so stripping that out makes a bigger difference to where you get a little bit more growth, though still not any type of rip roaring, soaring expectations for carload. Even taking out some of those really challenged commodities, we're still under 3% is our expectation in 2027, and then less than 1% in 2025. So that's the big picture on what's been going on with freight, whether trucking, intermodal, or carloads. Encourage any type of question that y'all might have, or any questions on the equipment stuff as we kind of get through this next section. So again, any question that you have, as you have them, please feel free to put them into the chat. But for now, we're going to start off just talking through equipment markets. We'll start off with some big picture indicators, just how these cars are moving through the networks. And then we will break out the latest ARCI results at a big picture level and then by individual car type. So this is a graph that we haven't shared on this webinar before, but it's one that I always reference for some of the reports that I write, but I never really put it out there. But there's been such a undeniable trend that has kind of been occurring across the number of cars that are actually moving through the network that I just thought it's important that we kind of highlight this to the group. So this is from the weekly reported number of cars online from the STB and looking at how these numbers have changed relative to January of 2025. And a lot of this weakness that we've kind of been seeing in the freight environment, you see even more of that weakness as you look at how many cars are actually being utilized, being used to move from commodities from point A to point B. Now, the reason why this looks so much weaker than our actual freight levels is because of how favorable just service levels have been. People that are shipping their goods from one part of the country to another are able to get quicker turns out of their assets. And so that's why you kind of see these broad declines across car types, even though overall freight has been pretty stable. But in any case, as the network becomes more fluid, there becomes less of a need for equipment because you're able to do more with the equipment that you already have. And so the number of cars that are actually moving on the network tends to decline. And that's very clear when looking here to where every major car group has seen a decline in the number of cars online relative to the beginning of 2025, with the exception being gondolas, though a lot of that, some of that's coming from limited strength in areas like scrap metal. But then a bigger part of that is going to be how in 2024 there was significant weakness in coal markets. In 2025, we kind of recovered a little bit from that. And so that's kind of even the one equipment group that hasn't seen a decrease in the number of cars online. It's most likely due to a temporary prop up of the coal markets that we don't expect to see sustained. So depending on whether you're a shipper or whether you are a equipment owner, that you're either going to see this chart as good news or bad news, but the big picture is just that the number of equipment moving on the network has been going down. And then looking at how much equipment is physically being built or taken out of the network, not necessarily being used to transport, but just looking at overall changes in the population of overall equipment in North America. Just a high level on what's kind of been the norm and then what actually happened in 2025. So we were from 2022 to 2024 kind of in this environment of replacement demand of new car activity was a function of replacement demand plus maybe 5 to 10,000 more cars of organic demand in places like medium or large cube covered hoppers, certain tank car fleets, automotive, certain box car, well, not necessarily the box cars. But you know what I mean. So there was cars that were just scrapping out that needed to be replaced, but then there were also a few pockets of organic opportunity. And that's where you would get, say, 30,000 cars dropping out in 2022, but then a extra 7,000 coming on or being built. 30,000 falling in 23, an extra 14,000 being built. 34 to 40, but then we kind of had this shift in 2025, a lot of that just due to hesitancy about we don't know what's going to happen, so we're not going to spend millions of dollars on new equipment, to where for the first time since 2021, we actually had the number of new cars being built fall short of the number of cars that actually got scrapped out of the fleet. With a lot of the cars that scrapped out of the fleet being underutilized assets that wouldn't really stimulate new replacement demand. Think small cube covered hoppers and cars like that. So that's just kind of an understanding of what that dynamic is like so far. And then we had a pretty big drop in registrations and scrappage in January, though January does tend to be a little bit of a slower month. So I'm going to wait before I get too worried about that. Wait a couple more months at least. So those are some of the big indicators. And then the last thing to say, these numbers differ a little bit from the RSI numbers. They're just two different data sources, so they generally line up. You'll notice some minor differences. And so that's some other indicators, and now we're going to really dive into the latest ARCI results, breaking down orders, deliveries, and backlogs at a high level and by the individual car types. So this quarter, it was an improvement from Q3, but it still was still kind of more of the same. We had another quarter of kind of stable deliveries, and deliveries were actually up quarter over quarter, which kind of brought us to north of 30,000 deliveries. So overall deliveries for 2025, 31,205. That was so. If you're not familiar with FTR, we do a delivery forecast every quarter. And I feel like we had the most optimistic forecast out of anybody that I really talked to for 2025. And we were still low. We were still about 3,000 cars shy of what actually happened, with that due to this quarter over quarter jump in Q4. And so big jump or not big jump, but a quarter over quarter jump in deliveries. We also saw an increase in orders quarter over quarter, but those orders still came in below deliveries, and that still resulted in a further decline in the overall industry backlog, which now stands at just 23,431 cars, which puts our backlog to delivery ratio at 2.8. So that's a number that I always like to make sure we kind of just talk through. What is backlog to delivery ratio? That's at current run rates, how much backlog do we actually have? So if we have 40,000 cars in the backlog, we're delivering 10,000 a quarter. That means at current run rates, if we don't receive a single another order, we still have 4 quarters of run rates before we run out of backlogs. I typically like to see that number at or above 4, somewhere between 4 and 6. And we dipped below 4 starting at I believe it was the third quarter of 2024. And then for this quarter, we actually dipped below 3, which is saying that backlogs are becoming very thin, much thinner than anybody in the industry really wants to see. And really, this is kind of not good news for anybody because it makes it much more difficult for an OEM to be able to accommodate, to be able to keep consistent run rates. It makes it difficult for them to have a strategic plan, which that's bad for them. It's bad for people that lease cars. It's bad for people that buy cars outright. And so nobody likes to see backlogs getting this thin, which they are getting quite thin. Looking at how that backlog has actually changed, and this is actually Q4 backlog. My apologies for not updating that title for Q4 backlogs over time. So it's been a pretty steady overall decline since 2022, and it's been a decline for each of the underlying equipment types, to where kind of everything has been whittled down pretty substantially. And what's left is very highly concentrated in just a handful of cars, most of them, and I believe it's over 80% of them are concentrated in either covered hoppers or tank cars, which I've kind of stated this several times before, but when you have your backlogs concentrated in just a few equipment types, your industry becomes tied to the industries, to just a handful of other industries, in this case, agriculture, chemicals, and energy. And so if those industries go up, then great, but if those industries go down, it kind of takes the rail industry down with it, or at least the rail equipment industry, that is. And so this is just, again, to drive home that backlogs have continued to get smaller and they've gotten more and more homogenous. So that's the big picture of what's been going on with orders, deliveries, and backlogs. Now we're going to take the next maybe 10 minutes, 10 to 15 minutes, and just talk through some of the big picture changes that are happening for each of the individual equipment types. And then again, any questions that y'all have on anything econ, freight, or equipment related, put those in the chat so that we have plenty of time to talk through anything that y'all want to talk through. But going through just one by one in alphabetical order, what we've been seeing with the of individual car types. So box cars, we had a few orders come in, so we didn't have any orders come in last quarter, but we had a little bit of a jump. But we did have quarter over quarter drop in overall deliveries and backlogs. And so even though we had a little bit of an upward movement in orders, it's still not that robust of an industry, despite the very old age of this fleet. What's been driving some of the most recent deliveries, it continues to be those over 60-foot and longer cars. And I believe that those were the one of so the most significant contributor, or possibly even the most, I'd have to confirm, driver of the orders that actually came in this quarter were those over 60-foot box cars. If I'm wrong, I'm sure somebody on this call will correct me. Then on the covered hopper space, so again, this has been this is the single biggest portion of the overall backlog right now, and it's really been more of the same. So it's been deliveries have come in, but orders have come in lower than deliveries, and so overall backlogs of these cars have continued to fall. We did get some order activity come in, and it was primarily concentrated among the over 5,500 cubic foot covered hoppers, used primarily for plastic service, though some of it still for some of your lighter agricultural products. But overall, we still had another decrease in the overall backlog for this equipment type. And then looking at which cars are actually being delivered out of the covered hopper fleet. So while it was the over 5,500 cubic foot cars that drove most of the orders that came in, as far as deliveries, it was more of the mid-cube covered hoppers used primarily for grain and fertilizer service that drove most of the deliveries this quarter. Though we still had a decent amount of the larger cube covered hoppers, and then a very small sliver of the under 3,500 cubic foot cars, which are not going to be your gravity gate cars, more likely used for something like cement or potash. Next, we have our open top hoppers, which this and GONS afterward, which we're going to talk through afterwards, were kind of some of the biggest surprises for the most recent report. So we had this really, if you look at that light gray line, we had this really decent jump in overall deliveries. But while we did see some orders come in, it wasn't enough to exceed overall delivery levels. And so we had a further drop in the overall backlog. And that's something that maybe I should have mentioned this earlier, but kind of just a big picture thing to understand about kind of how we see equipment markets looking like over the next 1 to 2 years, 1 to 2 years especially, is that our expectations were so our expectations versus reality for 2025 were low. Deliveries came in above what our actual forecast was for 2025. But because those extra orders weren't accompanied by sufficient, those deliveries weren't accompanied by sufficient order activity, we're kind of in this spot where we're seeing that the future market is really just being stolen from. So any strength that we saw in 2025, it's not an indication that we're going to have this lifting activity in 2026, 2027 until we actually get new orders come in. Any additional strength that we see now is really coming at the expense of future quarters. And so that's just something I wanted to point out, because that's one thing that's true here for open top hoppers is, yeah, we had great order activity, but that wasn't, those orders weren't replenished, or those deliveries weren't replenished with orders. And so that takes away future opportunity for this equipment type. And then, not surprising, all those deliveries were still the steel-sided, still no indication of aluminum, though depending on what energy needs look like in the country, depending on how quickly these coal cars fall out of the fleet. Who knows? Maybe one day in a couple of years, we actually will see an aluminum sided order, but there hasn't been anything to indicate anything like that recently or that it'll happen in the next couple of quarters. And then gondolas. So similar to the open top hoppers, this was a big surprise for the report. This is the biggest surprise for us, at least at FTR, to see. We were expecting to see some uptick in overall deliveries for these cars, but this came in much higher than what our previous expectations were. And this was the biggest reason for our forecast miss for 2025 was just this significant jump. I think it was over 100% quarter over quarter jump in deliveries. And so big surprise here, but then similar to what we saw with the open top hoppers, the order levels were not comparable to delivery levels. And so that resulted in a decrease in the backlog, which lowers our expectations for what these cars are going to, how many of these cars are going to be delivered in 26 and 2027. It was all the GB Steels that drove these deliveries, though I think we had some GT orders come in as well. But for the delivery side, the big jump were the GB Steels. I believe it was both the coil cars and Milgons that drove some of that growth. Next, we have our non-intermodal flats. So, interestingly, we did have some orders come in this quarter. So very low orders last quarter. And so that was one of the ones where we actually did see orders exceed deliveries. Unfortunately, it wasn't because of strength in this industry. It's because deliveries were zero. We didn't deliver a single one of these cars in Q4, but we did see some orders for the vehicular flats, which that was a more of a minor surprise for us. We kind of figured that that would be a little bit more of a shut door for at least next year, but we did see some of those orders come in, which is always nice to see. And then, like I said, after the market had been weakening coming out of 2024, so we had that big drop starting in the first quarter of 2025. Things got incrementally weaker, and then the lines shut down, and we didn't have any deliveries in the fourth quarter of 2025, whether either for those auto racks, those vehicular flats, or for any other non-intermodal flat car. Next, this is the second to last equipment group that we're going to talk through. So remember to submit those questions. But recent orders, we had a nice little jump. First decent order that we've actually had for intermodal cars in a while, and those were the 3-unit 53-foot articulated platforms that came through. So we had a decent little jump in overall order levels, but when we look at deliveries, we had just a couple. Let's see if we can see. Less than looks like less than 50 overall deliveries came in for intermodal flats, but that's a lot better than what we had seen for the 4 quarters prior, which was no deliveries. So there does seem to be a little bit of life in the intermodal flat market, which is nice to see. It's something that we haven't seen for a year now, so it was encouraging to see that. And again, it was those 53-foot platforms used for the transportation of primarily domestic boxes from point A to point B. And then the last equipment group that we're going to talk through is the tank car fleet. So this was the one area where we had both respectable levels of order activity and delivery activity. So unlike what we saw with the non-intermodal flats, where we had some activity in orders that exceeded deliveries, but deliveries were really low. Deliveries for tank cars have continued to be really steady. So continue to kind of keep that even pace of just at or above 2,000 cars per quarter. And then we had a decent little jump in overall order levels for tank cars, which were driven from both the pressure cars and the over 26,000 gallon capacity general service tank cars, often used for things like ethanol or for crude oil, some of your lower density liquids. And so again, overall, pretty steady levels of overall deliveries. And one of the biggest contributor to the quarter-over-quarter growth was for those large non-pressure tank cars over 26,000 gallons. Again, often used for transporting things like ethanols and crude oils. And so that kind of takes us through the prepared portion. And all these slides are available at on our website. So Haley put in the chat a link to download these slides. So if you want to download one of these slides, or if you want to download one of our reports like our Rail Equipment Outlook, you can also find it at ftrintel.com/rail equipment outlook if you want to get a sample of what that looks like, which includes not only our analysis into the equipment markets, but then our forecasts into what we think each individual equipment group is going to be doing over the next 1 to 3 years. And so with that, Carrie, I will go ahead and bring things back over to you.
Thanks so much, Joseph, and thanks to you also, Eric, for taking us through the webinar for Q4 of 2025. I took a look at the chat. It doesn't look like any questions have been added to the Q&A, but if there is anyone that's still participating and would like to take yourself off mute and ask your question, now is the time to do that. And I'll see, Haley, did you receive any direct questions? If you did, you can read those off.
I did not receive any direct questions, but if somebody would, unfortunately, attendees can't make them or turn themselves off mute, but if somebody would like to be removed, you can just indicate so in the chat.
Perfect.
What I just hear is we just answered every question. Is that
We
so?
solved the world's problems.
I think we're great then. So
Yeah, incredibly thorough. There, we got some hand clapping.
oh.
All right, so as Joseph stated, the slides that were just presented are available on the website. Haley dropped that into the chat. This webinar has been recorded, so if you do have colleagues that would like to watch this, feel free to direct them to the recording. We'll go ahead and send an email out to all ARCI subscribers. That'll be going out within the next day or two. But again, thank you so much for joining, Eric, Joseph. Always a pleasure. Thank you for taking us through that. Appreciate it. Have a great Friday and a weekend, everyone, and we'll see you next time.
Thanks,
Thank you,
everyone.
everyone.
Thank you.